Investing in dividend stocks can be a great way for investors to generate passive income. What's more, if you choose dividend stocks that you can hold for the very long term, you don't have to make too many decisions buying, holding, selling, making more transactions, doing research on new companies, which takes more time and you're probably a busy individual. So, in this video, I'm going to highlight 5 undervalued dividend stocks you can buy now and hold for the very, very long term.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right. The first in this list of 5 exciting dividend stocks. Well, I don't know if you can say exciting and dividend stocks in the same sentence for most people, but for me, dividend stocks and generating passive income is really exciting. So, the first of this list of 5 undervalued dividend stocks I'm going to highlight is McDonald's. The intrinsic value per share I calculated for McDonald's stock is $378, whereas the current market price is just $300 a share. Now, the weighted average cost of capital for McDonald's is very low. It's 7.4% because the company has a very low beta of just 0.56. One of the things I'm more excited about with McDonald's is the expansion of food delivery. People can now order McDonald's even when they're not leaving their home. Whereas previously, you can only enjoy McDonald's if you left your home either to go pick it up in person or to drive through one of its locations and order in its drive through. Now, with the expansion of food delivery availability, you can enjoy McDonald's whenever you want to, which expands the service area of every McDonald's location and also increases the number of times that people will order McDonald's during their meal choices in a given week. But more excitingly, some innovative features are coming out that McDonald's can further benefit from, including robotic delivery. If you are not aware, there's a small company I follow. It's called Serve Robotics. I've done a few videos on them. And they have these robots that are driverless and deliver food in areas here around Los Angeles. I see them all the time. And they're pretty agile and nimble, and they can work around sidewalks and they know how to avoid people. And they've worked really well from what I've observed in my neighborhood here in Los Angeles. That's another way and another positive tailwind for McDonald's, which can utilize this technology to deliver its food to people around the areas of each McDonald's location. The next undervalued dividend stock I'm going to highlight is UnitedHealth Group. The intrinsic value per share I calculated for UnitedHealth Group is $526. The current market price is $304. The weighted average cost of capital for UnitedHealth Group is 11%, and that's even though I adjusted the beta higher to 1.2 to account for the increase in risk for UnitedHealth Group stock because of the recent challenges the company faced, including the miscalculation of how much it will cost to serve its insured customers, and the fact that the CEO abruptly resigned, leaving a new CEO to have to take the helm with a little notice in advance to prepare for dealing with this challenge that the company faces. So, doing that resulted in the company withdrawing its guidance for the rest of 2025. And all of that just means more risk for investors. So, I accounted for that by increasing the beta on this stock. The intrinsic value per share, even after accounting for that higher beta, still signifies an undervalued dividend stock. By the way, if you want more detailed explanations and walkthroughs of all of these discounted cash flow valuations, I have dozens and dozens of exclusive videos for my channel members. You can join now for less than $5 a month. I think it's a great deal. I think you'll like it very much. The next dividend stock I'm going to highlight here is Keurig Dr Pepper. So the intrinsic value I calculated for Keurig Dr Pepper is $43 a share. The current market price is $32.95 a share. The weighted average cost of capital is just 7.6%, as the company has a relatively low beta of just 0.63. Of course, Keurig Dr Pepper has the Dr Pepper namesake brand. It has beverages, and then it has the Keurig side of the business, which is the coffee machine and the K cups that go into those Keurig machines. The business is not going to double overnight, but it's demonstrated steady growth, and the analysts that are following this company expect its free cash flow to grow from 1.66 billion in 2024 all the way up to 3.37 billion in 2029, more than doubling its free cash flow in that time frame. The next dividend stock I'm going to highlight is CVS Health Corporation. The intrinsic value per share I calculated for CVS is $80.29. The current market price is $64.26. The weighted average cost of capital is just 9.24%. That's despite the fact that the company has a lot of debt, over $80 billion in debt on the balance sheet. So I've given them a higher cost of debt to account for that elevated level of debt. CVS is closing locations to focus on more profitable locations as it's finding it challenging to get people to come into its stores. It's not alone in that fact. Many brick and mortar retailers are finding it challenging to get people to come into their stores, and closing and shrinking in size, I think, is a wise strategy for CVS Health Corporation. The intrinsic value per share is $16 above the current market price of $64, suggesting there is significant upside for this dividend stock. And last but not least, Visa, the payment services company. The company has over 4 billion Visa cards outstanding in people's wallets, and the competitive position, Visa, MasterCard, and others, they don't fight with each other in a race to the bottom that hurts profitability industry-wide. They facilitate transactions, giving merchants a way to monetize customers more easily and facilitate and grease the wheels of our economy. The intrinsic value per share I calculated at $404. The current market price is $371, suggesting there is upside here for Visa. Now, the weighted average cost of capital for Visa is 9.75%. The beta for this company is relatively higher compared to the others because it's more correlated to the macro economy. When people are going out and spending more money, when economic activity is increasing, that's better for Visa because it gets a percentage of every transaction and a small fee also for every transaction. So these are 5 undervalued dividend stocks that you can buy now and hold for the very long term. These are companies I expect will be around for decades, if not more, because of their established position, their competitive advantages, and one of those competitive advantages is the large scale that most of these companies boast. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.